Hello, everyone, and welcome to today's class where we discover the basic investing topics and how to go about finding good stocks for investments, how to value them, and how to buy them and when to sell them. My name is Yash, and I have been an investor for about 6 years, investing in Indian and US equities. I've worked in wealth management and private equity roles, and now currently I run my own fund where I use quantitative strategies to beat the market. So let's start right to the presentation. Let me share my screen. Okay. This is my company name, Above Alpha Solutions. So the first question, why should we invest? So I believe in this Warren Buffett quote that if you don't find a way to make money while you sleep, you'll work until you die. So you don't want that. You don't want to keep working just for a salary and exchanging your time for money. You want your money to be working for you. That is why you have to start investing and you have to start investing soon. So this is the value of 100 rupees reinvested from 1979 to now, which is about 40 years. So like you can see, invested just in the Sensex would have made 100 rupees into 1735 rupees versus a fixed deposit would have been 114 and gold would have just been 226. So equities massively outperform fixed deposits and golds in the long term. So you need some allocation to equity in your own personal portfolio. So today the topics we're going to cover are stock selection, some financial accounting, valuation, industry analysis, and stock pitches. Since today is the first beginner class, I'm going to go over these topics very quickly and give a very brief overview of these topics. Let's start with stock selection. There are over 2,000 companies listed on the National Stock Exchange, and it's not practical to go through all those companies and decide which stock is good to invest in and which stock is not. So you have to filter out from these stocks into range of stocks of 30 to 50, which then you can go through more properly. So some factors you can use while screening are return on capital more than 15%, debt equity ratio is low and not overly debt burdened. By that I mean the equity is more than the debt of the company. That means the debt equity ratio should be below 1. Then they have a high cash position, which will help them tide over crises like the coronavirus crisis. You typically want to buy stocks which pay dividends, which will give you some income even if the stock doesn't perform during the year. And you always want a company which has an operating cash flow of more than zero. That means you do not want to be buying loss making companies. There are a lot of venture capital players who do this, and it's a completely different style of investing. And I would not recommend it for the individual investor. So under financial accounting, what do things come? There are items which you have to know about, which are like EBITDA, which is earnings before interest, tax, and depreciation and amortization. Then you need to know depreciation. It's a non-cash expense. Then you need to know what cash flow from operations means. Cash flow from operations is typically what it signifies is during the year from its operations, how much did how much cash actually came into the company. Net income is typically an accounting figure, but cash flow tells you how much cash went into the company and how much cash went out of the company, which is very important to know because that's what matters. Because accounting figures can be really manipulated and inflated. So you don't always want to trust the net income at its face value. Always check the cash flow from operations and compare that to the net income. You typically want a company which has cash flow from operations more than that of the net income. Then you have to look at return on capital. Return on capital basically says that on the capital invested in the company, suppose they invested 100 and their EBIT is 20. So the return on capital is 20%. So that's a very good thing because most people don't get returns more than 10, 12% on their investments. So if you're investing in a company which is getting 20% on its investments, it's doing something right. Then there's asset turnover, which is again an accounting ratio, which tells you how effectively the company is utilizing its assets. Then there's dividend payout ratio. So that basically means from the net income, what percentage of the net income are they paying out as dividends, which is very important to know because that gives you an idea. Like typically a dividend company will pay out 50% or more of its net income as dividends, but growth companies pay out less than 10%. So it's not a hard and fast rule. It depends on the type of company you're investing in. Then gross margins. Gross margins obviously look at their cost of sales versus their revenue. So it compares that and says that if a company has high gross margins, it obviously does better. So you need to be familiar with items like these, and we will take a separate class for each of these items. So now once you found out a good stock, the basic concept is you have to pay for a stock something that is, you have to pay a price which is less than what it's worth. So suppose something is worth 100 rupees, you typically want to pay 80 rupees, because if something is worth 100 rupees and you pay 100 rupees for it, you won't make much of a profit. But if it's 80 rupees price and it's worth 100, you can make a 20% profit or more. So that's why you need to know valuation methods. So these are the three most common valuation methods used by institutions and big investors. The first and the most important one is the discounted cash flow method. So in this method, what people typically do is we forecast earnings and projections and cash flows 5 to 10 years into the future. And then we use the appropriate discount rate, which is known as the cost of capital for a company. And we discount these earnings to the present. And we then calculate the sum of these values of this cash flow and compare that to the market cap or the enterprise value of the company. So that will give you an idea of how much a company should be worth versus how much it's selling for. Then the second method is multiples and comparable company valuations. So what people typically do is they compare similar companies in the industry. Like if you look at the IT services industry, there's TCS, Infosys, HCL Tech, Mindtree, L&T Infotech. So these are all good companies and they're all trading at different valuations, and they all have different earnings growth rates. They all have different return on capital. So what people do is they compare companies in the similar industry and say, okay, out of these 10 companies, the average valuation is suppose 20 times price to earnings. So the company I'm buying, typically I should be paying less than 20 times price to earnings, and then I'll be buying a bargain. So that's how you look at your individual company versus other companies in the industry. It's always important to have similar types of companies for comparables, otherwise they can give vastly different results. So this method is a little more gray area, and you need a little more in-depth industry knowledge to apply this method. Third is the dividend discount model. This is the easiest method of valuation and is typically used for high dividend paying companies, like dividend yields of 3-4% or more. So what this does is this basically says that there's a certain dividend and it's going to be growing at say 5% every year. So what is that dividend worth today? So then you just divide that by the cost of capital and it gives you the valuation. So that gives you the dividend discount model. Okay, so now once you've got all of this, you need to go through the company analysis and the industry analysis. So how do you do this? So for the company analysis, you have to look at a few things, like what is the size of the company? Typically, a smaller company can grow faster than a bigger company. But on the other hand, a bigger company can typically command a higher valuation than a smaller company because a bigger company has less uncertainty. So the size of the company gives you indications of its potential growth rate and whether or not it can get a high valuation fast or not. Then you have to look at the market share in the industry. Is the market share of this particular company growing, or are other competitors coming in and taking away its market share? Then you have to look at the growth rate of the company. Is it faster or slower than the industry? You typically want to buy companies which are growing faster than the industry. Then you also have to do a SWOT analysis, look at strengths, weaknesses, threats to the company. So this will give you a comprehensive approach of your entire company and give you a better understanding of what you're buying. Because you have to understand the equity markets are incredibly volatile. And if you don't have faith and conviction in what you're buying, the volatility of the market will get to your head and you will most always exit in a small loss. So that's not a good thing. You always want to make profits on the stock you're buying and limit your losses. And when it comes to the industry analysis, you have to look at the size of the industry and the growth rate of the industry. There are some industries which are growing at phenomenal rates, and there are some industries which are growing very slowly. So that will give you an understanding of whether or not you're in the right industry at the right moment or not. Then you have to look at the market participants. How many people are there in the industry? Are there economic barriers to entry for this industry, or can anyone come in and set up shop? Then all those will give you indicators of what the industry growth rate might be and how the industry will develop over time. Then again, you have to look at the threats to the industry. Is it being disrupted by some other industry or some other companies? So all this will give you a good understanding of your company. So once you have all this down, you can come up with fair assumptions of a company, which then goes into your valuation models. Because valuation models are very mechanical. They have a simple formula and you have to give in your assumptions. So your assumptions only come after doing an in-depth analysis of the company and the industry. So that will help you do a valuation well. So now for everyone here, I would prefer before you actually dive in and start investing, I would want you to go and try out these like paper trading platforms before you actually buy your first stock. Because when you do that, you get an idea of how the stocks move, how volatility comes in, and then you'll be mentally prepared of what are the possible scenarios that can come after you've invested in a stock. So these are two websites. One is Wall Street Survivor and one is Stock Track. I would tell you to invest in these uh, platforms. They're free platforms to use, and you can start investing with these. Investing in US equities might be better because US equities are typically more volatile than Indian equities, at least in the smaller companies, and they don't have filters and things like circuit breakers which are there in the Indian industry. So they can, like, for a company, like taking example of this company called GameStop, there were people shorting the stock and the next day it went up 140%. So that kind of volatility is unheard of in the Indian markets. So it would be better if you look at these companies and try out paper trading. So the case study we will give out to our students is on Infosys. We'll send you two research reports, and we want you to read and understand how this company has generated wealth over time, what were the headwinds and tailwinds in this company, how it maintained high margins. It's a service company, so its return on assets will always be high because its assets are not physical and capital intensive assets, but their assets as people. So it's an asset light company. So it will give you a good example of what are the types of companies you should be looking at. So this is where we'll end our presentation here today. And if you have any questions, please feel free to put it down in the comments or message me directly, and I'll try to address them as much as you can. And I look forward to the next lesson with you guys. Thank you.